Good evening, everyone. Welcome to our revision classes. Very good evening to all present here in this live class. I'm sure now you all are at the peak of your revision. So you all are all geared up for taking up the challenge, right? Now, the topic that we are revising today is the topic of capital gain and other sources. Now we revise generally by taking up practical questions for which we have a compilation of all the past exam questions, MTPs, RTPs, and it has been compiled into a good question bank. So it should always take all the efforts for the students to ensure that we can provide you the maximum support, maximum help with relation to your preparations. Yes. Thank you very much, Ram. Thanks for your inputs. Yes, I'm also happy to see you all again. Actually, I should have come early, but I was occupied with some other commitments, so I joined from a later part. Oh, I'm happy to know that my PGPP notes have helped you. Capital gain notes, but I generally write it on my screen because capital gain is very vast. So whenever I teach capital gain, I write it on the screen so that I can draw some linkage. So I do not have any notes as such, and for theory, I always refer our module only, Ram. So, but okay, we'll take it. So first question to y'all. From where should I start? Should I take up the case scenarios directly? Means I'm sure you all would be in touch with the topic, with the particular chapter, so that we can jump to the practicals. Yes, be interactive because I want that you all should get the maximum out of the revision classes that you all are attending. And these revision classes should be the best, you can say, support and the best guide for scoring the maximum marks in exams. So for that, I want your constant inputs. I want your constant interaction with me so that we can understand what is, like for me, it is important to know where you all are standing, what are your challenges. And equally for you, it is important to understand where we are going through. So now since you all have given me the mandate, the permission, so let me take you to questions. If in that process you feel, sir, this is tough, we need some backup revision, then definitely we will take up that. Now, I will be displaying questions on your screen, but maybe to proceed further, I will swipe the screen above. So I'll request that you all take screenshots at proper points so that you can refer back because after this, when I scroll the screen further, I will be directly going to the questions. Now, if I keep on scrolling up and down, it may be not so comfortable with you all. So I'll request that, yes, the MCQ starts from here. So you can take the screenshot of the question bank. Question bank means a particular question as we are proceeding through so that it is easy for you to fall back whenever you want to go there. Because we have tried to compile all different questions from all sources that we have. So I do not know exactly which paper or which source this question belongs to, but definitely if you know it from where it is, it's fine. Great. So let us try to read the question, try to interpret, try to find answers. In this process, one thing is very important is the approach. Now see, first, you all know there are two broad types of questions. One is the case scenario type of questions as we have, and the other is practical questions. Now I'll give you an approach to handle both so that it helps you in saving your time in the exams. It helps you in interpreting correctly and answering in the precise manner. Now, when you are on the case scenario type questions, what you should do is, see, I never start reading the paper with line one. So if I'm getting the paper, let us say now you all are getting the papers 15 minutes before. So what should be your approach? You should scroll through the paper. Now, when I say scroll through the paper, how do you scroll through? So first is you make category of the questions. One, these are case study questions, which will have these MCQ type of questions. So that is called as case study or case scenario type questions. And then you have practical questions. So first categorization is this because you have two parts in the paper, part A, part B. So accordingly, you have to tick your strengths as to how you will be approaching the questions in what sequence. Now, when you are reading a particular question, and let us say you have selected a case scenario question, how do you read the question? You should not read from the case. You should come to the question. Now, what is the first question? Why I'm telling you? Because if you have this approach, it will save your time. How it will save your time, you'll come to know. Plus, when you're reading the case, you can immediately do markings because you know what you are asked. Because the case scenario covers everything. But out of that, whether the question coming to you is from HP, PGBP, CG, deductions, TDS, if you know that, you are more focused while reading the case. Otherwise, you first read the case, then you come to the questions, you again go back and you start searching. So all these times will be saved. Let us see how. So the first is compute the income. Now you have to be very specific whether they are asking tax, whether they are asking income. Again, they are asking income of one head or they are asking income of the entire thing. So be very clear and read the question very patiently. So what is asked? Compute the income, right? Under the head HP. See my markings. These are very important. So first question, is about HP income. Now, as you read the question, now this approach also helps in practical, but I'm just telling you because this is a practical question only, though part of a case scenario. What should happen is if there is a practical question, and I'm now particularly talking about tax and even you can say costing to some extent, the first thing that should come to your mind is, now I know what the question is, compute HP income. Now, the first thing that I will come or bring into my mind is the format. What is my format? GAV, municipal tax, NAV, standard deduction, and interest. Why this is important? You may even write it down somewhere, where somewhere not on the question paper, you can take the last 2 pages of your answer sheet, give the heading as rough work, and over there you can start putting down maybe in pencil, pen, whatever you want. What is the use? The use is now when you are going to read the question, you are very specific. So first part of the question is they want me to determine income from house property, which we all know is made up of these 4 figures. So now when I'll be reading the case scenario, this should be at the back of my mind that I have to search for 4 figures, GAV, etc., etc. Fine. Then again, it is asking me to compute income under the head CG. Okay. Now see, you need not write everything. I'm writing because I'm explaining you the approach also. So in this, again, since it is a practical question, what should come to your mind is format. What is the format? The format is full value of consideration minus expenses on transfer net minus index cost of acquisition, index cost of improvement. Yes. Now see students, the moment capital gain comes in, especially this assessment year 25-26, which is relevant to previous year 24-25, there is one very crucial date. Can anybody tell me which is that crucial date and what is the relevance of that date? Sure, let us interact. Even if you want to unmute and speak, that is fine with me. Somebody saying my video is freezed. I can see myself moving. I'm also making gestures. Sanketji, my video is fine. Na? Somebody said it is freezed. Acha, that was at 6:09. What is the time now? 6:10. Somebody just said. Okay. Perfect. Very good, Dhruti. So Dhruti has given me the date. Ram, it is not very clear. Sorry, it is not very correct, though somewhere you are close. Yes, students, especially for financial year or previous year 24-25, that is assessment year 25-26, in capital gain, we have a very important date. Name the date and also the relevance. You can unmute and tell me also. That is fine. Very good. Gulika, what is ST you said, Gulika? ST is what? Short term. Is it correct? Please check. Please check. So see, students, we are parallelly revising also. So the answer correctly given by many. Yes, Dhruti, so please tell what is that. So the correct answer given by many is that the relevant date for previous year 24-25 with respect to capital gain is 23rd of July 2024. What is the relevance? During this year only, there are two, you can say, mechanisms for computing capital gain. If transfer has taken place before this date, that is from 1st April 24 to 22nd July 24, for long-term capital gain, you will calculate it by the original method, that is by taking indexation. But from 23rd July onwards up to 31st March 25, if the transfer has taken place, general rule is indexation is not there for capital gain. Exception to that is, however, in case of individual HF, where they are given both options. Also, the rate of capital gain is different. For the pre-era before 23rd July, where indexation is applicable, the capital gain on long term will be 20%. From 23rd July onwards, where indexation is not applicable, or you are not opting for indexation in case of individual HF for land and building, the rate is 12.5%. Right, students? Anything else you all want to add to this? No? Super. Acha. Since today we are revising capital gain and other sources, out of the total question, I will be focusing on that. So we'll not go to the HP and other part, please, so that it will save our time and it will be more focused on the relevant chapter that we are assigned. So we will limit ourselves only to capital gain and other sources related question. But I will give you the approach. That is why I'm taking first question in detail, so that I can give you that approach which will be helpful to you while you are preparing for all papers. Okay. Now, when I go to the third question, what it says, the amount of tax credit, interesting, available to Mr. Vivek if tax has been deducted by the deductors. So, in short, it has some connection with TDS. And what it is asking you, the amount of TDS which Mr. Vivek has in his 26 years, which he can utilize while making payment of tax. So you have to determine the TDS amount, correct? Fourth is Mr. Vivek received maturity proceeds from both the policies of 40 lakhs, 27 lakhs, considering the most beneficial, which of the following statement is correct? Now, this is not a calculation driven question. So in this question, what is important is I call it as application of law provisions. So this question is more based on correct application of the law provisions as to what is what you can say the answer based on the interpretation of law. So that is what is this type of question dealing with. So in this question, I'm not writing the format. Why? Because I'm not going to do any computation. Rather, I will have to focus on the facts. Why? Because in order to correctly interpret and get the correct answer from law, your factual interpretation, your focus on the factual part should be very, very clear. So for answering this, it will be fact-based. Now, what I'm getting the impression from the details is that in this particular case, it is based on other sources chapter. Why? Because they are talking about maturity proceeds of policies. And I'm sure you all would be knowing this, that whenever any policy is matured, Wherever it is taxable, it will be taxable under the head other sources. Correct? Then the next is computation of tax liability. So this will obviously be dependent upon the two schemes, the default scheme, which is the new scheme, or the optional scheme, which is the old scheme, right? So these are the pointers. Now I have made a note of this. Okay, what all things are required in the question. Now I go back to the data. Now when I'm reading the data, I have marked what are the requirements. So maybe as I will read the data and as I'll start getting the details, I'll start punching in, I'll start putting in my format so that my time, which is generally wasted by students, why? Because they keep on scrolling up and down, they read the question, they go to the facts, and that is how they do it. So that will be saved, correct? So let us then deal with this. So what is given? Mr. Vivek Malhotra, Indian resident, has 4 residential properties in India. 2 of them are in Delhi, one of which is self-occupied. Now see, for me, it is immaterial whether it is Delhi, Mumbai, etc. for the time being. What is relevant is the place. The nature, correct? So the nature is, it is self-occupied, and the second one is let out at this monthly rental. So out of 4, 2 is given. So now I'll keep in my mind that, okay, it is not one computation because there are 4 properties, there are 4 computations, and within 4 computations, you know that there is a different rule for self-occupied and there is a different rule for let out. Further, what is given? The 2 properties are in Mumbai. So out of 4, remaining 2 in Mumbai. To reduce his tax liability, he gifted one of the residential house properties in Mumbai to his wife. Now, the moment you read gift and gift to your spouse, your minor child, what should come to your mind, students? What should come to your mind the moment you read this? Very good. Excellent. So what will come to your mind or should come to your mind is clubbing. Very good. And for this clubbing, you have to be very clear about the clubbing provisions as to when it is clubbed and what amount is clubbed. Correct? Very good. Again, interesting point. Club under which head? Answer is under the respective head. So the head to which that particular provision or that particular income belongs, it will be clubbed in that head itself. Correct? Okay. So now moving ahead, what it is given. So he gifted one of the residential houses in Mumbai to his wife and the second one to his minor daughter. Important. Both become liable for clubbing because the child is minor. So that is also where clubbing applies, right? Miss Pooja without adequate consideration in April 24. Expected monthly rent of self-occupied property in Delhi is 50,000 and monthly rent in Mumbai is 75,000 each. Now, why this expected rent is required? Because importantly, when you have gifted it to them and if they have not given it on rent, then it will be self-occupied. And in case of self-occupied, I'm sure you all remember this. If more than 2 properties are self-occupied, in that particular case, in case of more than 2 properties self-occupied, the provision is one will be treated as deemed to be let out. So that is where this expected rent will come into picture now. So one thing is for clear, from this part, you get your answer for computation relating to HP income, where you have to decide the clubbing. Yes, correct, Krishna. So up to 2 self-occupied, so there GAV will be nil, and for remaining, it will be taxed as if it is let out. That is, it will be deemed to be let out, where GAV will be your expected rent. Correct. Now we come to the next part. What it says, in addition, Vivek sold a plot of land. Now, what is crucial is, as I said, is the date. What is the date here? Because that will decide whether you have to do only one calculation, that is with indexation, or here 2 calculations. So what is the date? He sold the plot on this date. Now, if it is on this date, so it is after the 23rd of July. And since it is after the 23rd of July, hence you are now required to go for both the computations, right? So, in addition, Vivek sold a plot in Bangalore on this date for 49 lakhs, for which he paid 1% brokerage. So, this is your expenses on transfer. I'm sure you know this, correct? The stamp duty on the date of sale was 55 lakhs. Now, I'm sure for land building, you know how to determine the full value of consideration where stamp value is given. If anybody can just put it in the chat box, it will be good. This plot of land was purchased in 92 for rupees 3 lakhs. The fair market value and stamp duty value of this plot on 1st April again was this, and Vivek invested 12 lakhs in RECL bond. Correct. Now again, this part of the question is dealing with capital gain calculation. Now again, students, for capital gains, you all know what is the format. So the format is full value. Can anybody tell me what will be your full value here? So for full value, we need two things. What are those two things, students? In case of plot of land, those are your actual sale value and your stamp value. Now what you have to do, since your stamp value is higher, we have to make a calculation. What is that calculation? You will add 10% to check whether your actual value is eligible for being taken as full value. Now, how much will this amount be? So 10% added to this will be 53.9 lakhs. And your stamp duty value is 55. So what we should take, students? Chalo, help me. I'm not the one who is going to solve. It is, we are doing revision. So revision will be obviously when you involve, not only if I'm solving. Very good, Ram. Very good, Dhruti. Yes, correct, Ram. Gulika. Okay, correct, Khushi. Yes, Siddha. Very good. So finally, my full value will be 55 because my stamp value is still higher. Minus expenses on transfer. Expenses is 1%. And you should always know that 1% will always be paid on the actual sale value. So it is 0.49. So it is 54.51. Now we come to cost of acquisition. Now again in cost of acquisition, students, this date is important. Because if you have purchased any asset before this date, then the law says whatever is your actual cost, you have to compare it with the fair market value on that date, and whichever is higher can be taken as your cost of acquisition. However, again, for land building, if your fair market value is higher, they say that, okay, compare it with stamp value, and this should not exceed the stamp value. If it is exceeding, then the cost will be the stamp value. So I'm sure here you know that your cost of acquisition is 7. Now comes the most important point. What is that important point? Since the transfer is happening after 23rd July, you are an individual and it is sale of land building. So what happens, students? What will happen? Indexation compulsory or no indexation compulsory, or it is option? This is what I want to know. Is it compulsory indexation or is it option? Chalo, students, I will not answer. What is the provision, students, if transfer is taking place after 23rd July and it is land or building and you are individual? Students, I'm sure you all remember provisions. Means what? You're right. Very good, Gulika. So it is optional. And for this, you have to check both the workings. that if he is going with indexation, what will be the impact on tax? And if he is going without indexation, what is the impact on tax? Remember one thing, in income computation, you will always show the figure which is as per the new method, that is without indexation. Only while computing tax, see, this is also interesting. Your income computation will still be as per the rule, which is the new rule, that is without indexation, right? But when you are going to compute the tax, at that time, you will have to determine the tax by both the methods, that is without indexation, with indexation, and take the one which is beneficial to you. So this is very important, that in income computation, the income computation will be only without indexation. So law gives you option, but not in income computation. It is while determining the tax liability. I hope, students, this is clear to all and you all remember this. Yes, students, you all remember this? Good. Now see, this is where the point is. What is the point? See, what is given in the question, you have to be clear. The question is specifically asking you to compute income. It is not asking you to determine the tax, right? Now, since the question is only asking you to compute the income, so you should know that income will be computed only by the new approach, that is without indexation, right, students? So income computation is without indexation. Okay. So I will take the cost as it is without indexation. So what is my long-term capital gain, students? Students, what will be my long-term capital gain? Now, again, he has invested in bonds of RECL. Now the question is, whenever there is investment, we have to check what? Whether this investment is eligible. Eligible means whether for this investment, you are going to get the deduction, right? How will you check this? So first you should check which section, then you will check as per that section which asset, which assessee, then reinvestment in which asset and time period. Now, if I have sold a plot of land and I am reinvesting in bonds. So for bonds, the deduction is under which section, students? 54 EC. Wow, students have given me the final answer also. That's great. But let us derive final answer for others. So for 54 EC, yes, very good, beta. Who has given this answer? Khushi, very good. So for 54 EC, Khushi has said, ki, sir, the most important thing, time limit, which is only 6 months. But first you have to also check what is covered in 54 EC, what should be sold and what should be purchased, right? So land building should be sold, and what is purchased? The purchased thing should be the notified bonds. But the most important point is it should be purchased within 6 months as informed by Khushi. 6 months from the date of transfer. Now you have to check whether you have purchased it within 6 months. So sale was in December. Purchase is in July. Is it within 6 months? Answer is no. Since it is not within 6 months, so 54 EC is not applicable. So your final taxable capital gain is 4751. Correct? Is this clear? Dhruti, you said no. I did not get. What do you mean by no? Dhruti, you said no. No for what, beta? Achha, so you're okay, understood. So you're giving answer. You're saying that deduction is not valid. Very good. Okay, fine. Now in this particular case, since deduction is not allowed, my income capital gain will be 4751 only, right? First thing. Second important thing, here I will not go by the other option of with indexation. Why? Because that is to be done only at the time of tax computation. Please remember this, because many students make a mistake. they even do that computation when they are determining income. But for income determination, that computation is not applicable. Income will be only computed in this case by the new method, that is without indexation. But yes, when you are going to tax, at that time you have that option. So be clear with this, correct? So it is without indexation, and your final taxable LTCG is 4751. Fine, students? Clear? Hai? No doubts? Now coming to the important point. What is that important point? You have taken life insurance policy, and the policy A, which was taken on this date, and policy B, which was taken on this date for 10 years with a sum assured of 35 lakhs, 25 lakhs respectively. The annual premium payable on this policy is 3.5 and 2.5 lakh respectively. So this is about the policies. Now for policies, what was our question? So I think we have first answered this. This is D. Now tax credit, again TDS students, I'm not going because I cannot go to the other topics. So in financial year 33-34, that is the date of maturity, Mr. Vivek received maturity proceeds from both the policies. Considering the most beneficial to Mr. Vivek, which of the following statements is correct? The maturity proceeds from both policies is exempt. Okay. Maturity proceed from A is exempt, but B is taxable. Okay. Maturity proceeds from B is exempt, but A is taxable. And maturity proceeds from both A and B are taxable. Can you tell me what is the deciding factor, students, in this? On what basis you determine whether this is applicable or not applicable? That is exemption. Do you remember the provisions? When it is applicable, when it is not applicable? So anybody? When is the exemption applicable? When it is not applicable? Students? No one? Okay. Tax regime. Okay. Students, see, you should know the provisions. 1 second. I have capital gains with me, but this 1 second. I'll share other sources also. So, what is the criteria, students? Okay, 1 second. I'll share the screen. How do you determine whether the income from policy is exempt or not? So, see, here you have this question. 1 second. Where is the provision? Provision. Yes. Yes, this is the provision. So, with effect from 24-25, that is from 23-24 previous year, in case where, what is the condition? In case where an assessee has a single life insurance policy issued on or after this date. So first you have to go step by step. Is your policy issued on or after this date? Yes. Check this in our question. Hmm. So life insurance policy 15/5/23 and 1/7/23. Correct. These are the dates of issuance of these policies. Somebody is also answering. Okay. Now, what are the provisions? The provision is policy is issued on or after this date. Yes, it is. Exemption under 10D will not be available in respect of life insurance policy issued on or after this date if the amount of premium payable exceeds 5 lakhs for any of the previous years. Okay. This is where you have single life insurance policy. What you have multiple life insurance policy, which is applicable to our case. In case where premium is payable by a person for more than one life insurance policy issued on or after this date and the aggregate of premium on such life insurance policy exceeds 5 lakh for any of the previous year during the term during this would be available in respect of those LLPs at the option of the assessees whose aggregate premium does not exceed 5 lakh. However, to get exemption under 1010D, the condition of annual premium not exceeding 10% of actual capital sum also needs to be satisfied. Now, what is important is where you have more than one life insurance policy and they are issued on or after this date, the aggregate premium on such life insurance policy exceeds 5 lakhs for any of the previous year during the term of any of the life insurance policies. Exemption under this section would be available in respect of any of those policy at the option of the assessee whose premium does not exceed 5 lakhs. I hope you understood this. And also, if you satisfy the condition of the premium being below 10%. Now, if we apply these conditions to our question at hand, so sum assured is 35 and the premium payable is 3.5. Sum assured is 25 and the premium payable is 2.5. So, in this case, what will happen, students? How do we apply the provision? I hope you all get the answer. The answer is, the answer is, what will happen? 1010D would be available in respect of any of those policies at the option of the assessee whose aggregate premium does not exceed 5 lakh. So now it is up to us. And also the condition is premium should not exceed 10%. Now, interestingly, premium for both is not exceeding 10%, right? So both are eligible, but I can take exemption only for one. Now you tell me if I can take exemption only for one, then what will I do, students? What will I do, students? Yes, students, firstly, I hope. Very good, Ram. Very good, Dhruti. Khushi, correct. So, you all have pointed out correctly. When now both my policies are eligible, because firstly, independently, their premium is below 5 lakhs, independently. Maybe aggregate they are exceeding, but independently it is below 5. If aggregate also was below 5, it would have been exempt both. But aggregate is exceeding 5, but independently both are below 5 and both are not exceeding 10%. The premium is not exceeding 10% of the sum assured. In that case, both are eligible, but I can take exemption for one. And as rightly pointed out, I should logically take exemption for the one which is giving me more amount. So out of both, first policy is giving me 40 lakhs, second is giving me 27 lakhs. And if I'm having the choice, I'll take this as exempt and I'll keep this as taxable. Correct? So which of this option is correct, students? So as you all have rightly pointed out, Dhruti, Ram, Kushi, I'll take exemption for that policy which is giving me higher income. So that higher income will get exempt. So correctly, the answer is option B. Correct? Perfect, students. Very good. Yes, beta. Ram, go ahead.
Sir, I have this question, sir. Sir, according to the provision, it is up to ourselves to determine whether it is A or B, or the provision itself is telling that we need to take the most beneficial policy A.
See, they are very smart. They have not said what has to be done. They have left it to you. So you have to decide what you will do. So definitely what we will do is we will take
policy
the one which is more beneficial, which is what? which
It's for
is
policy number A.
exactly. See, I will go back to the provisions. Please.
Yes, sir.
See,
But
this is where it is important. See,
uh,
see, you should read. You will get answer in the question itself. So what it says, 1 second, would be available in respect of any of those policy at the option. Correct?
okay, sir.
I hope you got the answer.
Yes, sir. Yes, sir. Thank you, sir.
Excellent. So students, I hope you are getting this. Now, we go to the second case scenario. Again, the same rule. You can take a screenshot so that it will be easy for you all to refer back to the question when required. Right, students? So take a screenshot. Done? Now, what is our rule? We should first read the question. That is what is asked, so that you can be focused when you are reading the case. So what is the question? First, you have to determine the residential status out of the 4 which are available. Okay. Second, you have to determine the amount of capital gain chargeable to tax in the hands of Raj on the sale of debentures. Right? Super. So let us proceed. Now for this question, what does the case scenario says? Raj, aged 38 years, Indian citizen, carrying on manufacturing business, Canada. Okay, he's outside India, frequently visits India for business purpose, regular basis he was in India. Now this will help you determine his residential status. I'm just skipping because I wish to focus on the topics which are there for today's revision. Now, he does not own any house in Mumbai, is staying in rented accommodation, monthly rent, etc. Donation, vagara, very good. Now, he has purchased 10,009% debentures of company in August 20. Face value of the debentures is 100. Okay. He purchased at 150, so fine premium. He sold 2,500 debentures in April 24. Okay. And remaining 7,500 debentures in August 24. Okay. Now, how is it differentiating, students, whether it is sold in April 24 or August 24? Will there be any difference in that, or any difference is created? So we are revising. So because of this, many things will get revised. Okay, one is cutoff is July. Okay, Ram, but I think here cutoff July will not affect us. You know why? Because anyways for debentures, indexation is not applicable anyways for debentures and bonds. So for us, that doesn't matter. Yeah, Dhruti, I agree to that. Tax rate will be different. So I agree to this point. So that way Ram is also correct, cutoff July. But fine. The main point is, since we are not going to compute tax, so for the time being, tax is out of question, but you both are correct. What is relevant? See, when we are computing the capital gain, we always determine whether the asset is long term or short term, because only then the question of this will come. Now, what is the time limit for a debenture becoming long term? Okay. Kushi says, very good, Kushi. So this cutoff date is also relevant for one, rate of tax, because the tax rate on capital gain has changed, but that is only for long term. And yes, because the time limits have also changed for determining long term or short term. Okay. Now, in case by chance, if you all do not recall, see, this is how I also used to revise. I used to go back to the provisions when I'm solving a sum. So what happens? See, many times reading the provision directly is very boring, and it also does not retain. So my approach is, I used to take such practical questions of past exams or whatever material was available, and I used to start solving the question and with the question, I used to start referring the provisions. Now you know what will happen. even though otherwise you do not remember the rule for debentures period of holding for determining long term, short term, now you'll remember because you are dealing with a practical case. Now, as rightly pointed out by Khushi, if the transfer has taken place before this cutoff date, which Ram also mentioned, what will happen? Securities other than units listed in recognized stock exchange, 12 months is the criteria. This is also applicable for units of equity oriented fund and zero coupon. Then for unlisted shares and land building or both, it is 24 months. And for unlisted securities other than shares and all other capital assets, it is 36 months. Now, what has changed from 23rd of July? Securities listed, it still remains 12 months. Units of equity oriented fund, zero coupon bond, that is remaining same. All other assets have shifted to 24 months. Now, interestingly, what are we dealing with is debentures. Debenture is a security, yes. 12 months rule is applicable to which security? Listed. Here also, 12 months rule was applicable to listed securities. Unlisted share was in 24 months and unlisted debentures, and specifically pointed out because our point is debenture, was in 36 months. Correct, students? So see the differentiation because of that 23rd of July. Now, interestingly, in our question, the debentures were purchased entirely together on this date, but the sale happened on two different dates. 2,500 of the debentures were sold in April and remaining were sold in this period. Now the question is listed, unlisted. If these are listed, 12 months rule applies. If these are unlisted, then what rule will apply? Two rules will apply. For old debentures, sorry, not old, before 23rd July debentures, the rule is 36 months. After that, 24 months. Now, importantly, whether our debentures are listed or unlisted, amount of capital gain on sale of debentures, and here. Yes, students, listed or unlisted? Students, listed, unlisted? You will be taking it as unlisted only. Why? Had it been listed, that would have been informed to you. Since they have not informed this to you, these debentures have to be taken as unlisted. Now, if these debentures have to be taken as unlisted, now what will happen, students? Now, there are two interesting points. The debenture which is sold in April 24, for this, what rule will apply for long term? The rule applicable is 36 months. For debenture which is sold in August, the rule applicable is 24 months. And this is where the whole game changes. How it changes? So, for the debentures which are sold when in August 2020 purchased and sold in April 2020, since 36 months have not passed, these are short term. 7,500 debentures. What is the rule? For these debentures, since they are sold in August 24, for them, the rule applicable is 24 months. Correct, Gulika, you're right. They have mentioned that it is of private limited. So by default, it will be unlisted. You are correct. So that is why I also took it as unlisted only. Now, interestingly, the purchase and sale dates are not given, if I'm right. Only the months are given. Right? So, for these debentures, the period is 36 months for determining long term. For this, it is 24 months. So anyways, this is long term. Correct now? Students, please help me. Check and let me know. Are both long term, or one is long term and one is short term? Yes, very good, Khushi. Very good. So there is an important point. Besides this time limit, Khushi, very good, beta. Besides this time limit, there is this section 50AA, capital AA, which says capital gain arising from transfer of falling assets will always be short term, irrespective of their period of holding. What? Units of specified mutual funds, market linked debentures, and unlisted bonds, unlisted debentures transferred or matures after this date. Very good, Kushi. Students, now I'm sure you all will never forget this. So irrespective of the period of holding, the debentures, the unlisted debentures which are sold after this date will always be short term. So, 1 second. So for them, 36 months rule is applicable. And for this, they are always short term as per 50 double capital A. Correct? Now applying this is long term. So 2,500 shares are long term, 7,500 are short term. Correct? Am I right? And now full value of consideration. They were purchased for 150, 2,500, which are long term. They are sold for 175 and these are sold for 155. Okay. So here 175 minus 150. So 25 into 2,500. And here 155 minus 150 into 7,500. So 25 is a 625,000 and 5. Na? Yes. So half of this is 37,500. Yes. Is this clear, students? So this is long-term capital gain. This is short-term capital gain. What are this answer? Is this clear, students? Understood by all? Very good. Now I'm sure no one will forget this. This maybe you would have read theoretically multiple times, maybe revised multiple times, but what happens? Only when something like this practical comes, na, things remain in your heads. Correct? Okay. So let us proceed. Now here, there is no MCQ. So this is not a case study type of question. It is a practical question. Important date, 23rd of July, correct? Because that will decide indexation, no indexation. So Priya has always been financially aware, strategic with her investments. In January 22, she saw opportunity gold, purchased gold jewelry worth rupees 325. So this purchase is done in January 22, believing it would be safe investment in October 24. So it is after our cutoff date. She sold this on 31st of October. Now, one thing is sure, students, since it is sold after the cutoff date, what will happen? No indexation at all. Correct? Perfect, na? And since it is neither land nor building, so there is no question of indexation at all. Done? Understood? Students, so we will be computing capital gain compulsorily without indexation. And here, since it is not land building, there is also no possibility of doing indexation even at the time of computing the tax. Okay, so now you all have to help me. So for this gold jewelry, FVC, how much? 475, and cost of acquisition 325. Am I correct? So this is long-term gain on the first asset, that is your jewelry. Now we proceed. She also sold her house property on this date, again after the cutoff date, but now this is land building. Since this is land building, you have an option, but again, students, remember that option is only while computing tax. While computing income, this also has to be done without indexation. Please be clear. And here we are not computing tax, we are only computing income. Now comes the stamp duty value. Now we know you have to add 10%. This becomes 88 lakhs. Compare it with 90. So I know FVC is 90 lakhs. Correct? She had purchased this on 15/7/98. Very good. So this is purchased before 1st April 2001. So what you will do this compared with the fair market value, whichever is higher, but fair market value cannot exceed the stamp value. So ultimately your cost of acquisition is limited to 10 lakhs. And this is also long term. But again, students, indexation not possible. So another long term capital gain is 80. Correct? So this was 1.5 lakhs. This is 80 lakhs. Further, what else is given? Compute capital gain. Okay, done. So nothing else is there. So we have the answer. So this minus this 150 and this minus this. So this is your answer. Now, when you are computing tax on the jewelry, the tax is as per the new rate, no doubt. But on sale of house, you should do now the other computation as well, that is with indexation. And when you do computation with indexation, you will come to know which tax is lower. So now I'm doing computation with indexation 90 lakhs less the index cost. So 10 lakhs divided by 100 because this is the value of 2001, which is the base year multiplied by current year. So this is this. So capital gain is 90 minus this 57 into 20% is 10.74, right? And if I do it without indexation, that is as per the new method, that 80 lakhs, which is capital gain, multiplied by 12.5, the tax is 10,000. So obviously, I will continue with the new method and my tax liability on this capital gain will be freezed at 10 lakhs, which is as per the new method only. But here in computation of tax, you compare with the old method. I hope this is clear, students, right? Everybody understanding everything? Okay, again, take a screenshot of this so that in case I'm scrolling up and down, for you, it should not be a challenge. Correct? Now, what are you supposed to do? Compute the total income. Now, Mr. Aryan, resident individual working in Nischay, earns a salary of 90,000 per month. He holds 20,000 equity shares. Listed company purchase on this date. Okay. Students, what is special about equity shares? Anything relating to this date is relevant, students? Students, anything related to equity shares is relevant? Okay, Gulika says STT paid or not. Okay, very good. Fine. What else, Gulika? You're right. So STT paid or not? So that is given, was paid. So that point is gone. And it was paid both at the time of purchase and sale. Anything relevant for equity shares? So I'll give you all a hint. Any date relevant? The date relevant is 1st Feb 2018. How is this relevant? You all know? See, earlier the budget used to be presented on 20th of Feb. Now, since few years, we are presenting the budget on 1st of Feb. So 1st of Feb is your budget date. Now, in this budget, which was presented in Feb 2018, there was a major change whereby they said that for long-term capital asset being listed equity shares, there will be a special provision for computing the tax under section 112A. Now, because of this 112A, suddenly there was a big change, like how this year the change happened, that indexation is gone. Similar thing happened in that year. Now, since the budget had come on this date, 1st Feb 2018, they have kept the cutoff date as 1st of Feb, or you can say 31st of Jan 18. Now, what are they saying? That in case of assets which are equity shares, which are listed, which are purchased before this cutoff date, and obviously in our case, it is purchased before the cutoff date, you will be having the option, obviously you will take that only, to take the cost of acquisition as your actual cost or the FMV on this cutoff date, whichever is higher. Yes, you'll know this provision, students? You all don't know? Students, I'm asking you. No idea? You all don't know this provision? Very good. See, this is the benefit of revising with questions. Okay, okay. If you all don't recall, then let us revise. See, the best thing is if you're not able to recall something, you should go to the provision and revise. No problem. Even if you all don't recall. Now see, this provision was introduced, and because of this provision, they had to bring a change even in the cost of acquisition. Now, firstly, what is 1128? Is dealing with computation of tax in a special scenario. What is that special scenario? Somebody can help me reading. I have sore throat, so it is itching. Can somebody help me reading? Students? Any of you? Thank you, Dhruti. I'll unmute you. So, Dhruti.
Thank you, sir.
Thank you, Beta. Thank you for helping me out. Yes, please read this.
Section 1128, tax on long-term capital gain or certain assets. Any long-term capital gain exceeding rupees 1,25,000 on transfer of equity shares or units of an equity-oriented funds shall be liable to tax at the rate of 10% on such capital gain where the transfer takes place before 23rd July 2024 and at the rate of 12.5% on capital gain where transfer takes place on or after 23rd July 2024. If securities transaction tax has been paid on acquisition and such sale in case of equity share and on such sale is in case of units of an equity oriented mutual fund.
Okay, just wait. So students, keep this in mind that whenever in the sum, what you are selling is this highlighted portion. What you are selling is equity shares or units of equity oriented fund. And there is no need to say whether it is listed or unlisted. It is listed. Why? Because it is further saying if security transaction tax has been paid. Now, interestingly, in case of equity shares, it should have been paid both at the time of purchase and sale. Now, if this condition is satisfied, that your asset is equity shares, it is STT paid both at the time of purchase and sale, then your transaction will fit in 112A if it is long term. Interestingly, just for your reference, if the same transaction is short term, it will fit in 111A. See, what is 111A covering? Short term capital asset, transfer of equity shares, units of equity oriented fund on which STD has been paid. So interestingly, asset is same. So now you have to keep it in mind like this, that if the asset is equity shares on the transaction of which STT is paid, then if the equity share is short term, and I hope you all know when it will be short term, less than 12 months and more than 12 months long term. So if it is short term, 111A applies. If it is long term, 112A applies. So that is easy to remember. Now, if it is 111A, again, this cutoff date is important. Before that, the rate was 15%. After the cutoff date, it has been raised to 20% for short term. Now here, for long term in 112A, what is the provision? Pay attention, which is our present point. This is the point. Now this was introduced, whatever you are reading now, this was introduced on 1st Feb 2018. This all change exceeding 125 and all. Because of which they had to bring in that particular point, which I'm going to explain now. Now, before that, what is the point? Long-term capital gain exceeding 125 on transfer of equity shares or units of equity oriented fund shall be taxed at 10% if the transaction took place before the cutoff date and 12.5% if it is after the cutoff date. What is very important is in either case, before or after, the change is that you are not allowed indexation. Point number one. Point number two, which is the most interesting part, they have given you a sort of exemption. So whatever will be the capital gain on this transaction, it will be exempted up to 125. So up to 125, you need not pay any tax, right? Please proceed with it.
In case of resident, individual and HUF, the long-term capital gain shall be reduced by the unexhausted basis exemption limit and the balance shall be taxed at 10% or 12.5% as the case may be.
Continue.
No deduction under Chapter 6A or rebate under Section 87A can be claimed in respect of such long-term capital gain. Long-term capital gain.
One second. Two important points in this. Do you know what is this part? Unexhausted basic exemption limit. Now, I'm sure you all know the slabs. Now, for individuals, up to a particular slab, 3, 3.5, and that also depends upon old scheme, new scheme, the income is exempt, right? Again, in that senior or not senior, so there are multiple slabs, right? Now, the amount up to which, yes, right, 3 lakhs, 2.5 lakhs, up to which there is no tax is called as your basic exemption limit. Now, again, one more point I'm telling you. Now, this basic exemption limit, that is up to which you don't have to pay tax, is available only for those incomes which fall in slabs. like salary income, house property income, PGBP income. But I'm sure you all know this, that these incomes where a special tax rate is given like 10%, 12.5%, they do not fall in slabs. These incomes are having a flat rate, 10%, 12.5%, right? Now, when these incomes are having flat rates, please understand, the point is these incomes will not be coming or not becoming eligible for basic exemption limit directly. For these incomes, the law says you have a basic exemption limit, you utilize that for the regular incomes or the incomes which have slab rates like salary, house property, business, and many of the other sources income except winnings. So except those incomes which have special tax rates, for other incomes, you apply the basic exemption limit. So importantly, the basic exemption limit has to be used for those regular slab rate incomes, not for these special tax rate incomes. However, if you are an individual HF and you are a resident of India as per residential status, then in case your regular income, that is a slab rate income, is less than what? Less than your basic exemption limit, the shortfall you can adjust in this special rate income. So let us say simple example, you have only one regular income, which is income from house property, which is 50,000, the income. And you have this long-term capital gain under this particular section 112A, after reducing 125, after reducing this 1,25,000, your income is 10 lakhs. So you have 10 lakhs capital gain, 112A, this one, and 50,000 HP income. So total income is 1050. Now, interestingly, let us say your basic exemption limit is 3 lakhs. Now, in this particular case, if your basic exemption limit is 3 lakhs, the rule says it is allowed for the regular incomes which are having slab rate. So it is allowed for that 50,000. Fine. Okay, no problem. But I have slab of 3 lakhs, or my basic exemption limit is 3 lakhs, but I could utilize how much? Only 50,000. I'm still having unexhausted basic exemption limit of how much? In my example, 2,50,000. Now, if you are a resident individual HF, then this section says you can reduce this 2,50,000 from what? From this long-term capital gain. In other words, you can utilize your basic exemption limit even for this special rate income. But first, use it for regular rate income, which is under a slab rate. Whatever is excess, whatever is unexhausted, unutilized, use it here. I hope students, you understood this. Students, is this point clear to you all?
Yes, sir.
Pakka na? Or is there still any confusion?
No, sir.
The others are not saying anything. Was it too complicated? Did you all understand what I just explained about that basic exemption limit, unexhausted exemption limit? Okay. So Dhruti is saying yes. Gulika is saying clear. What about others? Now, this point, which is dealing with cost of acquisition. Dhruti, please read.
Long-term capital assets being equity share in a company on which STT is paid both at the time of purchase and transfer, or units of equity-oriented funds on which STT is paid at the time of transfer, acquired before 1st February 2018.
So this is exactly the same asset to which 112A applies. That is why I first took you to 112A. So we revised 112A also with that special point of unexhausted basic exemption limit, which is very important. And with that, we are also coming to the point of cost of acquisition. Now, for the same assets, that is equity shares on which STT is paid on both time of purchase and sale, if these shares are acquired before 1st February, why? Because on this date, the budget had come and those new provisions had come. So for them, what is cost of acquisition? Please read.
Cost of acquisition shall be the higher of cost of acquisition of such asset, and second, lower of the FMV of such asset on 31st January 2018, and the full value of consideration recorded or accruing as a result of the transfer of the capital asset.
So you have to take higher of these two values, value 1, value 2. But value 2 firstly has to be lower of two values. So what is this? FMV of the asset on this cutoff date, which is 31st of Jan 18, because the law was amended from 1st Feb, so up to 31st of Jan 18, and the full value of consideration of the asset. So first take lower of this and then compare it with cost of acquisition and take higher of that. Now, if this is clear, I come back to the question. So the question is first based on this point. So I have equity shares. STT is paid both at the time of purchase sale. So 112A applies. And since these equity shares were purchased before this cutoff date, hence to them this provision of cost of acquisition also applies. Correct? I hope this is clear to all students.
Yes, sir.
Pakka na? So now we have to determine cost of acquisition of this using this special rule which I just showed. Ram is saying somewhat clear. Yes, Ram, I know these things are complicated. You have to practice, and that is why practical sums are very important. See, reading that theoretically makes it not clear. You have to do it practically only. So I'm sure with this question, when you revise it later, it will help you understand. So this asset is fitting in 112A, and since the purchase is before the cutoff date, even the special provision of cost of acquisition is applicable. So for cost of acquisition, what you want? You want higher of. First value is actual cost. Second value should be lower of two values. One is the full value of consideration, FVC, and the second is the FMV on the cutoff date. Now I'll start putting figures everywhere as a fill in the blanks. So he hold 2000 equity shares, purchase on this date at the rate of 200 per share. So actual cost of acquisition is 200 per share. Okay. Now in between, they have put something of plot. I'll come to it later because first we complete the shares. So in November 24, Alpha decided to buy back 50% of its shares at rupees 250. So 50% of these shares are bought back. Again in May 25, Mr. Aryan acquired. So this is again dealing with something else. And then fair market value of these shares on the cutoff date is 190. Now coming to what is FMV. Now here we have one more special case scenario, that is buyback. Students, anything special about buyback in capital gains? Chalo, tell me. Anything special about buyback in capital gains, students? Try to recall. Yes? Students, anybody recalls? You don't recall? Okay. Ruti, are you there?
Yes, sir.
Please read.
In case of buyback of shares effected before 1/10/2024 by domestic companies, in case of buyback of shares, whether listed or unlisted, before 1/10/2024 by a domestic company, additional income tax at the rate of 20% plus surcharge at the rate of 12% and cess at the rate of 4% is leviable in the hands of the company. Consequently, the income arising to the shareholders in respect of such buyback of shares by a domestic company is exempt under Section 10(3)34A, since the domestic company is liable to pay additional income tax on the buyback of shares.
Now interesting. See, in this year only this date is also there. So if you are given the case of buyback, then the cutoff date which is falling in this year is 1st October 24. What does it says? If your buyback had taken place before this date, then for shareholders it is exempt. Now come back to your question. When is your buyback happening? Oh, we are unfortunate because it is happening after the cutoff date. Now, if it is happening after the cutoff date, we have to go to the new provision. Please read.
In case of buyback of shares affected on or after 1st October 2024 by domestic companies. In case of buyback of shares, whether listed or unlisted, on or after 1st October 2024 by a domestic company, the sum paid by a domestic company for purchase of its own shares would be treated as dividend and taxable under the head income from other source in the hands of shareholders. No deduction for expense would be available against such dividend income.
Very interesting. So, what is the first point? You are selling shares, but they are saying whatever amount your domestic company has paid to you, because it has done the buyback, so it is going to pay the amount. So, whatever amount it has paid to you, that amount will be fully taxed under the head other sources, and they have changed the definition of dividend, which is under section 2 bracket 22, to call this amount which is paid by the company during buyback as dividends. So interestingly, in this case, since our buyback is happening after this date, whatever amount we are receiving from the company is going to other sources. Now interestingly, what happens of capital gain? Please read.
Consequently, as per Section 46A, value of consideration received by a shareholder on buyback of shares by a domestic company would be nil, and the difference between the cost of acquisition and the value of consideration received by the shareholder will result into capital loss. The same can be set off and carried forward as per the applicable set off and carry forward provision of the Act. If it is long-term capital loss, it can be set off only against long-term capital gains. If it is a short-term capital loss, it can set off against both long-term capital gain and short-term capital gain. For detail, refer Chapter 5,
Okay.
Aggregation of
Okay.
Income.
Okay. So interestingly, what they have said, whatever money you will get from your domestic company as the consideration for this buyback, that entire consideration firstly is your other sources income. And secondly, interestingly, what will happen in capital gain? They say we will treat the full value of consideration as nil. You will have some cost of acquisition because you have purchased this. So since the full value is taken as nil and there is cost of acquisition, automatically whatever is the cost of acquisition, it will become your capital loss because the full value is taken as nil. Now, with all this, if I come back to our question, which I believe will help you. So we have to determine cost of acquisition so that we can determine capital gain. But for this, since the special provision is applicable because it is purchased before this cutoff date, so firstly, let me complete this. Now, what is cost of acquisition? It is higher of these two amounts. But between these two, you have to first take lower of this two. So lower of this two is nil, correct? And higher of this two is 200. So the final cost of acquisition of these shares is 200. Now, for buyback, what is the treatment? First is under the capital gain chapter. What is the treatment? Full value of consideration is nil. Cost of acquisition will be this cost. Now, how many shares are buyback? 50% shares. How many shares I was having? 20,000.
20,000.
So 10,000 because 50% is bought back. So 10,000 shares, 10,000 at the rate of 200. What is the amount? 10, 1 lakh, 10 lakhs.
20 lakhs.
and these shares are long term. So I will have a long-term capital loss of 20 lakhs. I'm only talking about buyback. So in capital gain chapter, you have a long-term capital loss of 20 lakhs. And at the same time, in other sources chapter, this is deemed dividend. What is deemed dividend? The amount which the company paid to me for this buyback. What is the amount that the company paid to me for this buyback? 250 per share. Again, 250 into that 10,000 shares, it is coming to 25 lakhs. So what has happened because of this tax treatment? In capital gain, there is a capital loss, which is the cost of acquisition. And whatever money you receive from the company for this buyback, entire money is your deemed dividend. I hope this is understood by all. Students, is this understood? Is this clear?
Yes, sir.
Good. Very good. See, I understand things are technical, things are complicated, but that is what is the beauty of the subject and specifically this chapter capital gains. Okay, so buyback done. So I've got one tax amount, which is capital gain, capital loss 20 lakhs long term, and other sources deemed dividend 25 lakhs income. Now there is one more thing. In August 24, Mr. Aryan transferred a plot of land in Chandigarh. Oh, again, it is August 24, so it is after our cutoff date. But again, for income computation, we will take the new method only, that is without indexation. He transferred the land for 70 lakhs, which was acquired by him in May 16 for 22 lakhs. So it is a long-term asset. He paid brokerage of 1% on transfer. In November, bought back proportionate. In May 25, Mr. Aryan acquired a residential property in Kanpur. So this maybe can be helpful to you while computing your deduction. Okay. Fair market value of equity share is 190. This is done. You are required to compute the total income if he is paying tax under the default regime. Now, I'll have to do computation of capital gain on this plot. Now, how it will be done? Full value minus expenses on transfer, net consideration minus no indexation, at least here. Why? Because the date is after 23rd of July. Now, what is the full value? I have sold this for 70 lakhs. However, since it is land building, you have to compare it with stamp duty value. In this sum, stamp duty value is not given, so I'll take complete 70 lakhs. Expenses on transfer 1%. 1% of 70 lakhs is 0.7. So it is 69.3. Correct? Cost of acquisition will be its actual cost, which is 22 lakhs. So this is how much? 47.3. Now what have I sold? I have sold a plot of land. Interestingly, I have purchased a residential house. Now this is a long-term capital gain on sale of plot of land. So LTCG 47.3. Now if I have invested this money in purchasing a residential house, which section will be available for computing the deduction? Which section is giving you exemption? Yes, students, you have sold plot and you have purchased house. It will be 54.
54 section.
Which 54? A, B, C, D. Which one? 54 has C. 54. Acha, you are saying only 54. No, 54 is
Yes.
not applicable because 54 would have been applicable if on both sale and purchase both is residential house. Here what you are selling is a plot of land. You are not selling residential house. So the section applicable, students, is 54F. What you have to sell? Any long-term asset other than house, and what you have to invest in is residential house. Do you remember? 54F? Yes, students, 54F clear?
Yes.
Now, if you recall this, now what is the working of 54F? It is slightly different. So the capital gain multiplied by amount invested upon net consideration. 40 lakhs is the amount invested. What is your net consideration? 69.3. So anybody has calci? Can anybody help me with the amount?
27.30.
This is what, beta? This is exemption.
27.30. Yes.
So what is taxable? 20.
Yes.
Okay. Now we have to do computation. Now in computation, okay, salary I did not compute. We come to capital gain. So first is on buyback. Full value is nil as per the amended provision. Cost of acquisition will be as per this mechanism, actual cost and higher of these two values, which is FMV compared with full value nil. So both these values is nil, and higher of both these values is 20 lakhs. So 20 lakhs becomes your long-term capital loss. Then on sale of plot, we also had, Acha, there is some fraction, beta. I think we did rounded, no problem. So you have long-term capital gain, we did rounded off, so it was 20 lakhs. And you have long-term capital loss, which is 20 lakhs. So as good as the final income outside is nil because the entire amount is set off. So effectively what you have over here is, one is this buyback, other sources, and the other is salary. Is this clear, students?
Yes.
Students, are you getting this? Perfect. Wow.
Yes.
Chalo, so there is one more question. I'll just take a break of 10 minutes. I'm keeping this question on the screen. Okay, it is a case scenario question. So it is on your screen. So in the meantime, you can just go through the question. You can take screenshot so that you can just go through them. Fine. So I'm taking a break. You all can also take a break of 5 minutes and then you all will start doing this question. I'll be back in 10-12 minutes, around 7:45. I will restart. Let us start, students. So now what is our approach? We have to first read the question, understand it belongs to what topic, and while reading the case, parallelly we'll do the markings so that we will be in line with the question and we are able to, without wasting time, get the answer, right? So I hope this approach is aligning with you. You will have to work on this so that you get expertise on using this approach. So what is the approach? Instead of reading the case first, you have to first go to the questions. So what is a particular question first? What would be the index cost of acquisition of a residential house property? So here you are not supposed to find out capital gain, but only index cost of acquisition. Fine. Then the amount of capital gain in the hands of Mr. Pankaj for this property. So both will be linked questions. Amount of capital gain for this year in the hands of Mr. Pankaj for sale of property at Mumbai. So please bear in mind there are two sales, so that you will get to know. One is for current assessment year, next is for the next assessment year. And then amount which is taxable under this section. What is this section dealing with, students? Anybody can tell me? Can anybody tell me, students, what this is dealing with? So that this section will also get revised. It is an important section. Yes, Khushi, Lokesh, Nagaraja, Ram, Siddha, Gayatri, Dhruti, Kaviya, Gulika. Kaviya, acha. Okay. Yes. So I have answers. Someone says forfeiture of advance. Someone says IFOS. Someone says gift. Okay. So first, is 56 to 10 dealing with forfeiture of advance? Yes. No. It is dealing with gift. Yes, it is part of other sources. Okay. Golika says yes, it is forfeiture. Let us revise. Simple. See, whenever in doubt, you should be having a simple approach. Revise. Read the section. Let us not make presumptions. Correct? And see, the best part is for quick summary, you can simply go to the module's last part. See, this is given by 56 to 10. Gulika. So it is dealing with gifts, correct? So since this is an important section, we are solving the case, that is fine. But I would like to first explain you this section and also give you the approach of how you can apply this section. So basically this section deals with what? This section we normally refer to as gift, but it is not exactly gift only, because the law has not used this word. We are using this word. So where you are receiving anything either free or for inadequate consideration, the law is treating the amount as gift. Again, not gift, because law does not use this word. We have created this word for simplicity. Now, interestingly, if you all remember, there is a limit of 50,000 also to determine whether to tax it or not. Now, there is many times confusion and even mistakes in applying that 50,000 limit. So I would start with talking about the 50,000 limit. Now, for applying the 50,000 limit, you have to make 5 categories for the gifts, or if I say benefit received. First, money received. Then, movable asset received, immovable asset received. Right? So money, movable asset, immovable asset. Now within movable asset, is it received free or is it purchased but for less than fair market value? So that there is a benefit. So what is the benefit? You have purchased it for less than fair market value. Then in case of immovable property, is it received free or is it purchased for less than stamp value? So these are the 5 blocks. Now why these 5 blocks are required? Because the 50,000 limit has to be checked separately for each block. Now, why do I use the word block? Because first thing, everything, all gifts combined together, 50,000 limit is not to be checked. It means you are given the 50,000 limit 5 times. But for each block, each category 5 times. Now, what is the first block or category? What you are receiving is money. So simply, people have given you money. And obviously, there is only one option in money, that is without consideration, that is free. You have not given anything in return. Now, when you receive money, even though you may have received other benefits, you will keep them aside. You will only add all the monies received by you during that financial year. So what is the first block? First block is of money received. Now this first block, which is of money received, will not cover the other benefits when you want to check the 50,000 limit. So somebody paid me 5,000, somebody paid me 12,000, somebody paid me 8,000, somebody paid me 9,000. I will add all them. And I will check whether this block, which only includes money received as gift, that is free, whether this exceeds 50,000. If this block exceeds 50,000, let us say the total money received is 62,000. Simple. Then I will take 62,000 as income. I will not subtract 50. 50 is only a criteria. We exceed 50, entire amount is considered as gift income. Fine. Now this first block is done. Now, second and third block are different. Second covers situation where you have received movable assets free. And in third, you have purchased movable assets, but you have purchased it for less than fair market value. So the difference is your benefit. Again, in this block, whatever movable assets are received by you. Now here there is one more important point. Whatever assets you are receiving, that should satisfy the definition of property. Only then these 4 blocks, you will include that particular item in one of the blocks. But if that asset, movable, immovable, is not fitting in the definition of property, you will not include it in any of the 4 blocks. What is the definition of property? We'll come into that a bit later. Now, what is the second block? The second block is where you have received movable properties, and maybe again in the year, different people have given you movable properties free. What you will do is you will add up the fair market value. So let us say somebody has given you shares free, somebody has given you jewelry free. All these are properties which are to be taxed in this particular gift. Now, whatever is the fair market value of shares, whatever is the fair market value of jewelry, I'll add up. Now, the total of this is 48,000. Now, interestingly, this already crossed 50. It was 62,000, entire 62,000 is income. But this second category, total of all the gifts which I have received in this category, have not crossed 50. It is 48. So this category is not taxable. Now, you will not merge the categories to determine 50,000. So it is block wise, it is category wise. So first category money, 50,000, done. Second category, 48,000, which is movable items received free, not taxable. So nothing is taxable in the second category. Now you come to the third category. In third category, what is again covered? You have purchased these shares, you have purchased jewelry, and you have purchased it below the fair market value. So let us say you purchase shares for 1 lakh, fair market value is 120. So 20,000 is benefit. You purchase jewelry where the fair market value is 550. You purchase it for 535. So 15,000 is the benefit. So what you do is you add up all the benefits in this third category. In this third category, you have to take the difference between the fair market value and the purchase price. And whatever is fitting in this block, what will fit in this block? All the movable properties which you have purchased at less than fair market value. Add the difference of all those purchases. Now make a total of this. Let us say this total comes to 75,000. Now interestingly, first 62,000 is income, second 48 is not income, third block 75,000, which is the difference of different purchases. Total of all these differences exceeding 50,000, it is income. Now when we come to fourth and fifth block, what is interesting is in first, second and third block, we were taking aggregate. All money received, all movable properties received free, all movable properties purchased. So we were taking the difference, but we were making aggregate. But in fourth and fifth block, where we cover immobile property, one, immobile property received free or immobile property purchased for less than stamp value, you will consider one transaction. That is, let us say you have purchased three properties are received as gift. But for determining the 50,000 criteria, you will not add up the stamp duty value of the three properties. You will take one property stamp duty value, and whichever property stamp duty value exceeds 50,000, only that will be your income. So what is important is in first three categories, you take aggregate. In fourth and fifth category, you take individual property value. See the value of the property, one property. Similarly, difference between the stamp value and consideration of the property. So one property at a time will be considered here. If the stamp value of that property exceeds 50,000, 50,000. That entire value is gift, and for each property, you check this 50,000 limit separately. In second, you have purchased the property for less than stamp duty value. Again, here that 10% rule applies. So if you have purchased something for 10 lakhs, stamp duty value is 10 lakhs 50,000. We will not take the difference. Why? Because the purchase price plus 10% is 11 lakhs. Stamp duty value is below 11, so you will not consider the stamp duty value. There is no benefit. So that 10% margin you have to keep. So this is how you will treat or determine whether it is exceeding 50,000 or not. So it has to be determined taking 5 blocks separately. Second important point, there is a list of those gifts which are not taxed here. What gifts are not taxed? Where you have received the money or the property from relative. Most important, on the occasion of marriage. Now here, what I want to explain is, because see in exam question, these are the minute things which are important. Here one is the definition of relative, that you will have to keep in mind who is a relative, who is not, because gifts received from relative is not taxable, from non-relative is taxable. Then here, it is not saying on the day of marriage, it is saying occasion of marriage. What is the meaning? So let us say you are getting married this year. When in this year, let us say 15th of August 2026, you are getting married. This year means next year. Now, it is not necessary that everybody who wants to give you something for your marriage may be giving it on that day itself. Some people may give it prior, some people may give it after the marriage. So that is immaterial, the day or the date. You should be able to prove that it is received by you because of your marriage, because generally during marriage, people give you some gift. So this is the general protocol, that people give you gift at the time of marriage. So it is not necessarily the date of marriage. Second, importantly, gifts are given to the bride and the groom plus their family members. Now, interestingly, only the bride and the groom, that is the girl and the boy who are getting married, are only eligible for this benefit. That is, for them, the gift received by them is not income because they are getting married. But because of their marriage, if their parents, their uncle, aunts, their brothers, sisters are also receiving gift, which happens in our Indian families, in that particular case, these people will not be covered under this relief. For them, so let us say in the question it is given, gift received, let us say jewelry received as gift on the occasion of your brother's marriage or on the occasion of your daughter's marriage. You have received some gift. It is okay, possible. It is not covered in this exemption. You will have to include it in your income as other sources. right? Then the other list is there, under will, in contemplation of death, etc. So this is what is important, students. Now with this, let me come back to our question. So I just thought of giving you the broad understanding because this is an important concept which is asked regularly in income in your papers of income tax. So we have to determine the amount which is taxable as gift in the hands of Mr. Gaurav. Then the next question is tax credit. So it is dealing with TDS. Okay. Now let us go to the facts. So in facts, first you have to determine cost of acquisition. Then you have to determine the income. Then you have to also determine the income. So both the incomes are capital gains and they are to be determined for house property. One is in 25-26 and then the other is 26-27. So we have to be very clear, very cautious when we are dealing with this. Correct? Okay. What is given? Mr. Pankaj, Indian resident, purchase a residential property Kanpur. Now, we all know if it is purchased before 1st April 2001, what is to be done? You have to take the actual cost, compare it with the fair market value, but before that, compare fair market value and stamp value. You have to take whichever is lower. So fair market value is this, stamp value is this. So whichever is lower is this, and compare whichever is higher. So I know the cost of acquisition of this property is 25 lakhs, correct? Now, on this date, 5th of Feb, Pankaj entered into an agreement with Gyan for sale of this property for 61 lakhs and received 2.5 lakhs as token or advance. However, as Gyan did not complete the transaction, Mr. Pankaj forfeited the advance. Now, this is interesting. Now, for advance forfeiture, student, there is a date. You remember what is the cutoff date for advance forfeiture? Because again, there are two provisions in that. There is a cutoff date. The provisions are different if advance is forfeited before or after that date. Very good. So Gulika has correctly mentioned the cutoff date is 1st April 24. Ram has also correctly mentioned. Khushi has also given the complete answer. So if your advance is forfeited after 1st April 14, what is the effect? 14, but not 24, Ram. It is 2014. It is an old point, but it affects our question because in case of capital gain, you have assets dating back. So it is 2014 only, Ram. Now, if your advance was forfeited after 1st April 14, then whatever advance is forfeited, it is your other sources income. But if it is forfeited before 1st April 14, you know what is the rule? If it is forfeited before 1st April 14, yes, very good, Gulika. It has to be reduced from your cost of acquisition. So forfeited after 1st April 14, treat it as other sources straight away. Before 1st April 14, it will be reduced from your cost of acquisition. Now here, that is important. So on this date, he entered into an agreement. It means this amount is forfeited. So this forfeited amount is your other sources income of assessment year. This, I'm assuming he has forfeited immediately because no dates are given, because anyways it is not relevant to this point. But one thing is important, because we have to compute cost of acquisition, so it will not be reduced from cost of acquisition. Why? Because it has happened after the cutoff date of 1st April 14. Now, on 10/5/24, very good. Why very good? Because it is before the July date. So only one working is required, that is with indexation. Pankaj sold the house property to Rohan for 1.5 crores. Now again, since Imol property sold for full value, you have to check stamp value and all those things. So stamp duty value 2 crores. Now what we do, plus 10%. So 15 plus 10 is 1.65 crores. Stamp duty value is higher. So your full value is 2 crores. Further, he purchased 2 residential houses at Delhi and Mumbai, each on okay. He has no other income for PY 24-25. The due date for filing return is this. Excellent. Fine. Now, in this date, he decides to sell. So that is later on. Now, firstly, we need to find out cost of acquisition of this. So that we have done, but this will be indexed because the transfer is happening before our 23rd July date. So multiplied by the current year upon 100. So can anybody help me with the figure? 90.75. This figure is given to me by Khushi, 90.75 lakhs. Let's see if we have that as answer. Yes. So answer will be B. We'll check the answers later. I also have to compute capital gain taxable. Now for computing capital gain taxable, so I will subtract index cost of acquisition and it is 90.75. So how much is your LTCG students? 90. So it is 1 crore 9 lakhs 25,000. Correct, no? Yes, Gulika. Now, what is important, students? You have reinvested. So you have sold house and you have purchased again a house property. Now what? If you have again purchased a house property, what has to be done or what has to be checked rather? Yes, students, what has to be checked? You have to check eligibility for exemption. Exemption here under which section? You have sold house, you have purchased house. So section is 54. So now I have to check eligibility of exemption under 54. Now 54 is applicable to whom? Individual HF. Yes, you are individual HF. What you have sold is your residential house. Yes. What you have purchased is another residential house. Yes. But what is the point? The point is, very good, Gulika. The time limit given for investment is 1 year backward for purchase, 2 years forward for purchase. Correct, Nagaraj. So has he purchased within this timeline of 1 year backward, 2 year forward? Yes, students. 1 year backward, 2 year forward. Has he done that? So his sale is on this date, 10/5. 1 year backward would be he should have purchased it between 10/5/2023 to this date. That would have been backward. And forward, he should have done it up to, let us say, 10/5/26. On which date he has purchased? He has purchased within the time limit of 2 years. But exemption is not applicable. I'm giving you the answer. You have to give me the reason. Capital gain exemption under 54 is not applicable in this case. Why? Yes. Why? Okay. Lokesh is saying he should purchase only one house. Lokesh, but is it rigid? If he purchases 2 houses, will he not get the exemption for 2 houses? You're right. I appreciate that you highlighted this. Gulika, perfect, beta. Lokesh, you are right, but here that should not be a challenge because I can purchase two houses. There are some restrictions. And if I satisfy those restrictions, I can claim exemption for both the houses, which will be allowed to me once in my lifetime. So I could have done that. So 2 crore limit is also satisfied. Na? Your full value is 2 crores only. So even you are satisfying that limit. Correct, na? The problem is rightly pointed out by Gulika. You have invested this, but by what time you have to invest? See, we say 2 years forward for purchase, 3 years forward for construction, but the crucial date is this. What is this date? Due date of your return filing. Now, why this is crucial? Because after this date, even though you have purchased the house within time limit, it is of no use. The rule is either you should purchase the house before the due date of filing returns, or if you want to purchase it after the due date of filing returns using the 2 years timeline, you should have first deposited the amount in capital gain deposit scheme. Do you remember? So if you want to use that 2 years timeline for purchase, 3 years timeline for construction, which is given in 54 exemption, that timeline can be used only if you have deposited the money in capital gain deposit scheme. Correct, na? Do you remember? Or should I go to the provision? Yes, students, remember? Recalling that if you want to utilize this 2 years, 3 years timeline, you should deposit the amount in capital gain deposit scheme or capital gain account scheme. Yes, Nagaraja, correct. Good. Since he did not deposit the money, even though he's making investment in 2 years, not eligible. I hope this is clear. Perfect. So I'll get my answer because I have to also compute capital gain, which will be is not exceeding 10 crore. Yes, so that's what I'm saying. So 10 crores is for what, beta? That is another point. So that is but for reinvestment. So anyways, it is not exceeding the 10 crore and all. So that problem is not there. Perfect. So you're not eligible for capital gain exemption under 54 because you should have deposited the money in capital gain deposit scheme. Since you have not done that, you are not eligible. So your final taxable capital gain. Now, we have to find out the capital gain of 26-27. What has happened in 26-27? He has sold residential property at Mumbai. So he had purchased two residential properties, Delhi, Mumbai, both at 57. So for this property at Mumbai, cost of acquisition is 57 lakhs. When did he sell it? 31-26. So it is long term, short term? Short term. Why? What is the time period for land building becoming long term, students? And how much time land building will become long term? Students. And how much time land building will become long term? Two years, 24 months, correct? Very good, Nagaraja. So you purchase in September 25, immediately sold in Jan 26. So it is less than even 6 months. So it is a short-term asset. Now what price you are selling? Pankaj used to sell the house property in Mumbai to his brother Mr. Gaurav for rupees 58 lakhs, from whom 25,000 was received in cash on this date. Wow. As advance for signing the agreement. The sale deed was registered on this date. On receipt of balance amount through account pay check from Gaurav, The stamp duty value of the house is this. Now, so this is a short-term asset. So cost of acquisition is a purchase cost. There is nothing special in that. But for full value, again, what is the rule? You take the actual sale price, which is 58 lakhs, and you compare it with your stamp duty value by adding that 10%. But here, the interesting point in this question is, you agreed to sell this on this date, and you took a token from him. Then finally, the sale happened on this date when you signed the sale deed, when the sale deed got registered, and you received the balance amount. And between these two dates, the stamp duty value is different. So now the question is, which stamp duty value should be taken for comparison and deciding what will be my full value, 61 or 64? So this is again a special point, that when stamp duty value has to be taken. And there is, and see, generally in case of property transaction, this will always happen because property transactions are high value transactions. So you agree on a date, but by the time you arrange the money and the property is finally sold to you, there can be a time gap. So in this case, okay, Khushi is saying the second date. Yes, anybody else? Anybody else? Khushi is saying it is 30th of March. So which date has to be seen? 31st Jan, that is a date on which you agreed, or the sale deed date? The law says our preference is the first date. That is the date on which you agreed, because that is the date of your transaction. Okay, registration took place later, that is fine, but our first preference is this. But then you agreed on this date, there has to be some proof. So the proof is the advance or the token. But then the condition is the advance or the token should have been paid only by way of account pay check, account pay draft, or any of the notified mediums like NEFT, RTGS, etc., etc. Now, since you have taken the token advance in cash, we cannot allow you this date. That is what is the provision. Had you taken the same advance token by way of account pay check, then we would have taken this date and the answer would have changed. So I repeat, the law says when there are two dates, one is the date of agreement and the other is the date of finally registration, you will take the first date only, that is the date on which you have contracted. But to prove that, whatever advance you are taking, that should be taken only by account pay check draft or by the notified medium, which includes NEFT, RTGS, UPI. Since here it is received in cash, this date is not important, or this date will not be considered. So the relevant date is now 30th of March. That is the date of sale deed. Now we take the stamp duty value. We compare 58 lakhs by adding 10%. So how much has become 58 plus 10 is 63.8. So 64 is higher. Your full value is 64. Your short-term capital gain will be. Is this clear, students? Did you get the reason? See, answer is not important. What is the logic for that answer? What is the, rather I should say, provision? Because as I said, two types of questions are there. One is computation. One is on the basis of law application. This is law application question. This is not computation question. Computation is simple. You have to only subtract. But which value to be taken, that value is dependent upon the law application. Correct, students? Correct. Now, we have to determine the amount taxable under 56(2)(10). But for this, we have to determine, is there anything by way of gift that I have received? Now, is there anything given in the question where you have received free? Firstly, for which financial year we have to find out this? They have not mentioned financial year. Okay. Now, in 25-26 assessment year, is there any gift you have received? Now, gift received may be either gift received or you would have purchased something at less than the fair market value, stamp duty value. That difference will be gift. So in 25-26, okay, I do not find correct. Na? There is nothing, na, students. Then here he's selling the properties. There is nothing in gift. Why have they asked this question? What is there in gift? Nothing is there in gift. Yeah, but this 10% beta is sale, na, Gayatri. We are selling, na. So at the time of sale, the difference is not considered as gift. That is because anyways you are taking the higher value, stamp duty value you are taking. So anyways you are taxing the higher value, na. So Gayatri, here that stamp duty difference is not gift. That stamp duty difference will apply as gift when you are purchasing it below the stamp duty value. Here you are not purchasing it below the stamp duty value. You are selling it below the stamp duty value. Now, since you are selling it below the stamp duty value, it is not applicable. Correct, Gayatri? If you would have purchased, see, we have purchased this here, 57 lakhs, but they have not given the stamp duty value of this. Let us say they would have given the stamp duty value of this, then we would have checked whether there is gift, that is a difference in the stamp duty value and the purchase value. Correct? So, since purchase time stamp duty value is not given, we do not have gift at all. In fact, I am amazed why this question is there on gift, because there is nothing of gift in this question. But yes, maybe as you said, maybe we may this may be given to confuse us because we may take the difference in the sale price and the stamp value as gift. But as I explained, gift will be on the purchase side difference of stamp value and purchase cost, right? So here the answer will be nil. So with this question, we are able to even revise our 56.2. Now this is also on shares. So let me ignore this because we have already done some on shares. Let me take you. Oh, correct. Should I take this? Again, here, see, it is stamp duty value on different dates. And what is important is you have to see. Oh, Nagaraj is asking what? Why taking 57 lakhs? What is 57 lakhs, beta? You're talking about previous sum, Pankaj sum. Where 57 lakhs we have taken, beta? This sum, na? Which 57 lakhs you are saying? Acha, here, cost of acquisition. Because beta, we purchase it for 57 lakhs, na? So while computing capital gains, 57 lakhs cost minus the full value after comparing with your stamp duty value. So that is how I got 57. Nagaraja. Correct, na beta? Beta, you are making a lot of typo errors. That is why I'm not able to understand what you are saying. Okay. Now see, in this sum also, what is the point is that there is difference 3 dates. You have received 20% through account paycheck, 60% on possession, balance. Now there are 3 dates because it is done in 3 parts. So which date stamp value has to be taken? The answer is simple. Since this is happening by way of account paycheck, you will take the first date, that is the date when you all agreed to get into this transaction. That date stamp value will be taken. Okay. I think we'll take up this sum only because it appears to have some complications. Chicken. Let us take up this. Ashish entered into agreement with Dhaval to sell his residential house on this date for 80 lakhs. The sale proceeds were as under on the date of agreement on possession and on registration. Fine. Dhaval was handed over the possession of the property on this date. Okay, who has sold to whom? Ashish has sold to Dhaval. And the registration was completed on this date. Correct. So this date is 15/12/24. This date is 14/1/25. Correct. He paid the sales proceed as per the sale agreement. The value determined by the stamp duty authority on 16/8. What is 16/8? Acha, so this date is 16/8. Okay. So on this date, the stamp duty value is 90. Then on 14/1, it is 91.5. Okay. Ashish has acquired the property in this on 1/4/21 for this, recovering the sale proceeds from Dhaval. He purchased another residential house property in Kanpur. Okay. Compute the capital gain for the assessment year. Okay, so we have to do capital gain computation in the hands of Ashish, correct? Na? So FVC minus COA. What is the date of sale? 16/8/24. Okay. So again, after the change. Okay. So now students here, which date stamp duty value will be taken for comparison? It is this date. Why? Because the token which is paid through account pay bank draft. Since it is account paying bank draft, this date will be the date for taking the stamp duty value and not this, correct? Now, sale value is 80 plus 10% is 88 lakhs. Compare it with 90, whichever is higher. Sorry, stamp duty is higher, so you take 90 lakhs, correct? Now, what is cost of acquisition? Cost of acquisition is 20 lakhs. Now, again, even though you have the option of doing indexation, but that will do at the time of tax computation. While doing capital gain computation, it will be done like this only. Students, I hope this is clear. You have to be very particular with the provisions. Don't mix between the provisions. So here, it will be done without indexation here. Yes, maybe later on, you can do with indexation when you're dealing with the tax. Now, he purchased another residential house for 15. Now we have to check whether you are eligible for exemption under 54F. Why? Because you sold house, purchased house, right? So when did you sell and when did you buy? You bought in April 25. And when did you sell? Okay. And it is done before your due date of filing return. So it is eligible, students. Correct now? So taxable LTCG will be 55 lakhs. Correct, students? And that is what is the question asking. Compute the income. Now, Gayatri, since in the previous question, we were talking about the gift side. So let me just add one thing in the question, though not asked. Let us go to the purchaser side also. Correct? So this computation we did for the seller, that is Mr. Ashish, because that is what is asked. Now what will happen in the same question in the hands of Mr. Dhaval? Sure, let us understand this. So from Dhaval's side, what has happened? He has purchased a property for 80 lakhs, of which the stamp duty value is 90 and 91.5. Now, whether for Dhaval, this difference will be gift or not, that is what we have to check. So first we will check whether Ashish and Dhaval are related person. No, they are not. Whether this asset is covered in the definition of property. Yes, it is a property, immovable property, land, building are covered. See, what is the definition of property for the purpose of treating it as gift? It should be a capital asset. So building is a capital asset. Yes. Residential house is a capital asset. Yes. So this is fitting in 56(2)(10), that is gift provisions. Now, how do we compute gift? In case of immovable property transaction, we go property wise. So here we do not club. So had I had 3-4 transactions, I would have taken each transaction separately to determine whether it is gift or not. How to determine whether it is gift? So in the hands of Dhaval, it will be income from other sources under section 56(2)(10). Now, what will be the difference? The difference will be the difference between stamp value and the purchase value. Now, he has purchased this property from Ashish for 80 lakhs. Stamp duty value, again, there are two. Now, out of which stamp duty value will be taken? Same rule. You have to see whether the token was paid by account pay check or draft. If the token was paid by account pay check or draft, this date is relevant. If not, then the registration date will be relevant. Now, since token is paid by account pay check or draft, this is relevant. Again, whether we have to consider this difference as gift income or not, for that, again, the same criteria at 10%, 88, still stamp duty value is higher. It means you will consider this for a gift. So, Gayatri, I hope from this you'll get the answer or an idea. So how the gift will be calculated in the hands of Dhaval? This 10 lakhs will be treated as income from other sources by way of gift in the hands of the debtor. So see, in this question, I added this second part just to give you the feel of how to determine the gift income in this transaction. But gift income will not be determined in the hands of seller, because for seller, you are anyways taking stamp duty value while computing capital gain. So again, the difference cannot be taken as gift. The difference is taken as gift in the hands of purchaser. So I hope, Gayatri, it is clear in this sum and it is also clear to everyone else. Yes, students, understood? Clear? Super. Correct. So students, we conclude our today's class. So I'm sure a lot of things you would have revised, recalled. So I'll request that do it in this fashion. Take up a question, start solving the question. And while solving, if you are not able to recall, go back to the provision, read the provision, come back. This is the best way of revising. And after you have solved some 20-25 sums, then revise the whole chapter as theory. That will be much, much helpful in retaining the concepts. I'm sure today, those 2-3 points, like the debenture treatment, like the buyback treatment, like that 112A point of what should be cost of acquisition, these would now remain with you forever. Plus this point latest, that how to see which date stamp value is to be taken, because in previous sum, it was by cash. So we took the later registration date stamp value. In this case, the token was paid by account paid bankrupt. So we took the agreement dates stamp value. Correct? Okay, I have some queries. Nagaraja is saying for individuals HF, if their total income excluding capital gain is below basic exemption limit, then it basic exemption limit can be reduced from long-term capital gain. Perfect. The remaining amount of long-term capital gain will be taxed at 20%. Perfect. Excellent, Nagaraja. You're perfect. Super. Ram is saying, sir, I'm afraid of capital gain. See, beta, remember one thing. There are chapters in every subject which are difficult to understand, or after understanding difficult to retain. Capital gain is one such chapter. Why? Because there are so many provisions. Ram will tell you how to deal with it. See, in capital gain, you have different category of sums. What are these sums? Like sums on shares, sums on land building, correct? Maybe sums on some other things. Do one thing, Ram. Don't try to prepare the whole capital gain chapter if you are finding it very... See, why you are getting the fear? Because there are so many provisions, you are not able to remember, you are not able to apply it at the time of the question. So it creates a burden. Do one thing. Break the chapter. Remember only provisions relating to a particular type of transaction. Shares, one type of transaction. Land building, another type of transaction. Gold, jewelry, another type of transaction. Try to break the chapter into specific type of transactions, because see, you have seen all the sums will be coming transaction wise. Majority transactions are land building. So do one thing. Leave all the points in this chapter. Only focus on all the provisions relating to land building, right? From point 1, whether 24 months, 36 months, 12 months will apply for determining long-term, short-term. Then full value, where that stamp duty value will come. Then cost of acquisition, where previous owner cost, 1st April 2001 cost, all those provisions will come. Then exemption under 54. So just do all provisions relating to land building, and instead of leaving the whole chapter in option, at least if you're lucky and you get that particular question, it is beneficial. So it is fine, beta. There will be tough chapters in every subject, and not 1, 2, 3 chapters. That is why 50% average is what is required. Don't worry, Ram. This is part and parcel of professional course, correct? Kushi is saying, sir, there is no difference in old regime and new regime. Yes, you're right, Kushi. So as far as the tax rate, old regime, new regime, 115 BAC is concerned, capital gain has no difference. You're right. I'm science students, even though I'm trying, but often I doubt myself. Thank you for helping me. Or PGP notes are useful, easy to digest. Yes, beta, but that is with PGP, because PGP can be understood that way. So that is why I'm saying how to understand capital gain. I've given you a trick. Don't go provision wise, go transaction wise. Correct? Do one thing now. Make a list of all provisions relating to land building. Everything. Whole chapter only land building. Then whole chapter only shares. Whole chapter jewelry. See, try doing this. Suddenly you will find that out of everything, many things are irrelevant because they are very specific to one or two transactions. Ignore them. These are common ones. Only work on them. Fine, better. See, these are tricks how you handle complicated, difficult, vast topics. And this is in every chapter, every subject, sorry. Fine, students. So we complete our today's schedule. So let us sign off, but with a promise from you that you all will practice and you all will emerge not only with 50, 60 marks, but my expectation from you all is 70 marks. See, you have a 116 marks paper. Out of 116, I'm asking you to get 70. So I'm allowing you the leverage to not know a paper of 46 marks. So out of 116, you get me 70 marks. So I'm giving you leverage of not knowing 46 marks paper. Correct? Thank you. Good night. Take care. Yes, madam. Thank you. Nagaraj asked, do we determine the cost of acquisition of asset acquired on or before 31st March? No, madam. That rule is only for equity shares and equity oriented funds. See, this is where you will now understand. So that's why I said now make category land building and write all provisions at one place for land building. In that, this will not come because this 31st Jan 2018 cost of acquisition is only for listed equity shares on which STD is paid on both sides or equity oriented fund on which STD is paid at the time of sale. Correct, beta? Super. Okay. Chalo then, thank you. Please work hard and we'll be in touch. Any question, doubts, you can always connect to us. Fine. Good night. Take care. Sanket ji. Sanket ji. Okay, good day. Bye bye. Sir, we close.